What's up everyone, how's it going? Welcome to today's video. Now the question that we'll be answering today is why diversification is so critically important when it comes to systematic trading and trading in general. Now typically when you look at the retail trading scene and the markets and the entire social media scene essentially, people say pick one strategy, pick one and stick to it. Now, I'm going to show you why this might not always be the best. Now, this does not apply for strategy has different entry models to it. And this is more so applicable to systematic trading, but it's also for those discretionary traders that only take one type of trade and one type of model and don't diversify themselves to different type of other profitable models. You see that most of these profitable discretionary traders are actually the ones that have a variety of different entry models and game plans to approach the market no matter which condition, so that their returns are varied enough but still profitable so that their Sharpe ratio is actually decently high. So we're going to be running a quick experiment here today, right? I'm going to show you a non-correlated strategy or non-correlated system versus a correlated system. So again, we're going to use a Claude and ChatGPT, use Claude to prompt the strategies and use ChatGPT to give the code and actually run the code itself. So let's ask Claude this. Hey Claude, I need you to make an imaginary trading system using imaginary stuff. The returns for these strategies will use a randomized coin flip scenario so that we don't need any market data, but rather just win rates, etc. Does not actually have to be a coin flip, just set rates, etc. Right? Make, let's just say 5 strategies. One strategy has a win rate of 50% and has an RR of, let's just say, risk reward of 1.1. One strategy has a 20% win rate and has an RR of 7. That's not good enough. 20% is profitable, but distribution of returns is a fat right tail. One strategy has a XYZ blank, one strategy has an XYZ, one strategy has an XYZ. Make those last 3 strategies up in a similar manner. Ensure that results aren't too good. Ensure there is still randomization when it comes to returns. But also make sure that the strategies actually are uncorrelated with each other, less than 0.5, less than 0.4 for overall. Give me a prompt that I can give to ChatGPT to code these strategies and show the equity curve for the 5 strategy diversified portfolio versus a singular strategy, and ensure that there are set risk per risk percent per trade measures so that capital utilization can be universal. Make it display the metrics such as Sharp, etc. for the singular strategy, and also the diversified system equity curves. Now this is a pretty detailed prompt, but you should be able to do this yourself as well after a bit of practice. Now it's going to give us a prompt, it's going to make these strategies, right? Just take a look at this. Let's go. Copy, let's paste this here. Runnable Python code. Okay, let's see this, right? Now this might take a bit of a while to code everything, so I'm gonna pause the video and come back when it's done. Okay, so it's just been completed. I'm gonna go ahead and run this within ChatGPT as well. If you don't want to run it within ChatGPT, you can always open up a Google Colab or a Jupyter Notebook or something of that nature as well. So let's hopefully see if the did the code right. Let's see. All right, let's see. Okay, first of all, look at the total return. This is not realistic, but the main focus is that the diversified 5 strategy portfolio is much more than that. Damn. Okay, I'm gonna zoom in so it's gonna be easier to see. There we go. Maybe zoom out a bit. There. Okay. If we look at just a mean reversion for I mean the returns are clearly much higher. 5 strategy portfolio does have a bigger max drawdown, has a lower win rate because they're traveling. But what I want to see is that I want to see the capital utilization for both. Ensure capital utilization for singular strategy is 0.1% per trade, and same for combined portfolio, 1% risk per trade, and take multiple trades a day still into multiple strategies, so overall may exceed. Now maybe this will help understand more, but essentially the main thing from that is that we saw the diversified strategy perform so much better and have such a better Sharpe ratio than the base. So I'm just gonna use whichever one completes first. Pause it, come back when the code is done. Okay, the code is basically done. I'm just gonna prefer the longer response, and we're gonna go ahead and run this right here. And hopefully this shows you, and then the video will be concluded after that. So, I mean, very similar stuff. The Sharpe ratio of the 5 strategy portfolio is 2.91, when the individual strategy only has a Sharpe of 0.19. Now, no correlation pair exceeds. Don't even worry about these equity curves. The main thing is that when we look, there's essentially, I'm gonna do this. Give me the metric table for the combined system and all of the strategies, all of the separate strategies as well. I'll come back when the code is done. This should be the biggest example. Okay, the code has been complete. Let's go ahead and run this. And let's see. Okay. It's assuming we have the strategies already. So I'm going to copy this code and we have to do this in Google Collab. So I'm going to go ahead and paste it here. Run it real quick and then I'm going to copy this one over here. And then there we go. There's all that. And now I'm going to code, include that. Hopefully we get our results. Okay, there we go. Just take a look at the Sharpe ratio. We see that this trend follower strategy is insanely crazy, right? So just kind of ignore that, right? We see that the Sharpe ratio for any individual strategy never exceeds that of all 5 portfolios combined. We see that by diversifying and including all 5 systems, every single measure of every single metric essentially improves, except maybe the max drawdown, of course, because we're taking overall higher risk. But the Sharpe ratio is the highest. This might not be the best example because we have a few of these strategies are made up, so most of them may not be realistic. But by diversifying, our Sharpe gets higher, which typically should reduce our max drawdown. In this case, it didn't because the risk is still high on all 5 portfolios, but just assume that typically it does. And that's the importance of testing all of these things out. If diversification actually helps a portfolio, of course you should do it, but you should test it out before as well. But I mean, yeah, that's the main takeaway of this video. This is why diversification is important. It's because by diversifying, you get better risk-adjusted returns, assuming that the different strategies or entry models are uncorrelated to a certain extent. So, hope you learned a thing or two from this video. I'll see you guys in some of our next compilation videos. I'll see you guys then.